A lot of REITs today trade at steep discount relative to the net asset values. And so what it means is that you essentially get to buy real estate at a discount in the REIT market and then get the added benefits of liquidity, diversification, professional management, and so on. And so, if you're looking to invest in real estate, I think you should be considering REITs.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Jussi Askola, president of Leonberg Capital and author of the recently published book, The REIT Advantage, which a number of REIT CEOs have already endorsed. Jussi also has an active YouTube channel and a REIT newsletter and has authored award-winning academic papers on REIT investing. Jussi, thanks for coming on the podcast today.
Thank you very much for inviting me.
So to start off, can you describe your journey into the world of REITs and what motivated you to spend about 3 years working on your new book?
So I started working on the private side. So I was working for a small private equity real estate investment firm. And while everything was great about that company, in many cases, I felt like our investors would be better off by simply investing in publicly listed REITs. And so that's what initially triggered my interest in REITs. This led me to first start blogging about REITs on a platform called Seeking Alpha. This then led to an opportunity to start a REIT newsletter called High Yield Landlord, which is today, I think, one of the largest paid REIT newsletters online with 2,000 plus members on board. Then I started advising some small family offices. I started working for some individual REITs to try to help them improve their investor outreach in some cases. Most recently, I worked for Embassy REIT, which is the biggest REIT out of India, co-sponsored by Blackstone. Most recently, I wrote this book, which I have here. It's called The REIT Advantage. And the reason why I wanted to write this book is because I feel like to this day, REITs remain wildly misunderstood by most private real estate investors. Most investors seem to think that private real estate is a better investment, and so they allocate in those investments rather than REITs, when in my opinion, they should be doing the opposite. I think that REITs are not just more rewarding, but they're also safer and require less effort. And I felt like a book was needed to make that case, and it needed to be very comprehensive. And that's why an entire book was needed and not just an article online. The current books on REITs are great, but very often they only very briefly compare private real estate to REITs, when I think that this is the most interesting topic that we should be focused on. And so that's the case I try to make. I try to explain why I think that REITs are better investments than private real estate in most cases.
So what do you think are the most complicated or challenging aspects of REITs that potential investors struggle with?
I think it's a widely misunderstood sector to this day, and I think it's in big part because it's a bit of a hybrid between stocks and real estate. And unfortunately for REITs, real estate investors typically don't trust the stock market, whereas stock investors don't really understand real estate that well. And so this has led to a lot of misconceptions. And there are a lot of them, but perhaps the three most common ones are the following. The first one is that REITs don't enjoy the benefits of leverage. I often see this cited online as a reason to favor private real estate instead of REITs, but it's fundamentally incorrect. What investors seem to ignore is that what we see traded on the stock market is the equity value. And so when you're investing in a REIT, it's the equivalent of making a down payment when buying a private property. And REITs then add leverage on top of your equity, of course, to achieve better returns. So it's no different than private real estate. It's simple. The only difference that confuses investors is that they don't have to take the loan themselves, the mortgage themselves. The REIT does that for them. Another common misconception that I see online is that REITs are not tax efficient, and investors will then favor private real estate because of that. Finally, a third misconception that I see often online is that management teams are self-dealing and highly conflicted, which just isn't the case. And there are many studies on this topic. But I think that these are probably the three main misconceptions, but there are many others. And so I discussed those in my book. I felt like it was important to address those because you cannot have a good debate of private real estate versus REITs unless you understand all these foundational concepts.
And is it a case of investing in one or the other, private or public, or do you see a healthy combination of both?
So I don't think it has to be an either or. I think that perhaps the best risk to reward is achieved by combining both as part of a well-diversified real estate portfolio. However, where I disagree with most real estate investors is that I think that REITs should be favored in most cases. Again, because as I said earlier, I think that REITs in most cases offer better returns with lower risk and less effort. However, there are exceptions, of course. Some of those exceptions are that perhaps at the time REITs might become overvalued. They might trade at large premiums to the net asset values, and maybe then it might make more sense to buy private real estate. Another exception might be for your home. Home ownership has some non-financial benefits that REITs cannot compete with. Or perhaps you want to target a very specific property in a very specific geographic market that's not well covered by the REIT market. Then obviously you have no other option than buy private real estate. But yeah, I think that it's not an either or. I think it's good to combine both together. I just think that in most cases, REITs make more sense for the majority of investors.
What things that you look for in a REIT management team and the strategy they pursue?
That's a good question, because I think that the management is the number one most important thing to look at when assessing a REIT. And I think that this should always be the first step of every REIT analysis, since if the management is conflicted, I think that the rest of the story becomes completely irrelevant. The REIT might have the best assets, the strongest balance sheet, but none of that will matter if the management is conflicted and self-dealing. So the management should always be the first step. And so things that I look for here are things like the management structure. Is the REIT internally managed or externally managed? Today, the majority of publicly listed REITs are internally managed, and this is the better management structure, in my opinion. It means that the management is hired as employees of the REIT. The compensation will typically be tied to some key performance indicators that are reflective of shareholder value creation. But some minority of REITs are still externally managed, and this will often come with greater conflicts of interest. I try to avoid those REITs in most cases. But there are other things. You'll look at the track record of the REIT. Have they shown a clear focus on growing on a per share basis? So are they just trying to build an empire for themselves to justify higher salaries, higher fees? What's their capital allocation plan? Are they buying back equity when their stock is heavily discounted? Are they issuing new equity when they're trading at a premium? So you look at past decisions, their track record, the management structure. You also look at, do they have skin in the game? Do they own some equity themselves? Is their compensation structure tied to important KPIs that are, again, indicated of shareholder value creation? I think a great example actually to take here is Agri Realty Corporation, which is a net lease REIT that I got to visit recently on my trip to Michigan. I visited their offices, and I think that they're a great example of a REIT that's very well managed. The REIT was started by the father of the current CEO, Richard Agri, and today it's led by Joey Agri. They have never sold shares themselves. They've been, in fact, even buying shares in the open market in the millions. They have significant skin in the game. They are clearly focused on growth on a per share basis. And again, the results speak louder than words. They've been massively outperforming their peer group over the past decade. And so I think that this is a good case study for people who want to see what a good REIT management team looks like.
And turning to the REIT sectors, can the range of property types be a little bit overwhelming for potential investors? And how do you advise that they narrow down their search?
I think so. And, not just for first-time investors. I think that can be overwhelming even for REIT specialists, because the REIT market today is really vast and versatile. There are 20 plus different property sectors with some very niche asset classes like cold storage, data centers, cell towers, billboards, timberland, cold storage. I mean, there's a lot of things. And to understand the supply-demand dynamics of all these property sectors at once can be truly overwhelming. But as you think of how to screen down what property sector you're the most interested in, you need to start by really asking yourself what type of investor you are. What's your risk tolerance? What's your need for income today? Are you more growth-oriented, total return-oriented, or do you focus more on generating safe and passive income? Or, because different property sectors are very different in terms of their risk profile and ability to generate consistent income. Hotels, as an example, are very cyclical. They don't enjoy long-term leases to protect your cash flow. And if we go into a recession, discretionary spending might go down. They might take a big hit. But on the flip side, they might generate higher returns when the economy is booming and they're enjoying rapid growth. Another example to use here might be net lease REITs. I just mentioned Agri Realty. That's the opposite of hotels. They typically enjoy 10 plus year long leases with steady cash flow that's highly consistent and predictable. So again, if you're a more conservative investor, perhaps a retiree looking for steadier income, then perhaps you'll be looking at net lease REITs instead of hotels. At the same time, also, again, maybe we can take the example of an investor who's more total return oriented, more aggressive and looking to really perhaps earn big upside. in those cases, you might want to look at property sectors that are troubled today and because of this heavily discounted. The life science property sector, as an example, today is really suffering. There's significant oversupply. But if you're long-term oriented, perhaps the low valuations might catch your attention and it might be an opportunity. I'm not sure about it, but so it's a vast sector and there's not one REIT that will fit every investor. It depends largely on your risk profile, return objectives. I think that that's the first thing you should assess as you try to determine what's the right property sector for you.
And are there certain REIT sectors today that you're particularly excited about?
Yes, they are. One that I like a lot right now is that of strip centers. I think that, and to be more specific, those that are grocery anchored, service oriented. This property sector is today undersupplied because retail has been out of favor for a long time. We haven't built enough new retail space. And as a result of this, now occupancy rates are hitting decade high levels. At the same time, same property NOI is growing steadily at 3 to 5% per year. So the fundamentals are great in this property sector, and I expect this growth to continue. But despite that, the valuations of these REITs are actually quite reasonable. And again, I think that this is simply because retail has been out of favor. There's been this sentiment that all retail will suffer because of the continued growth of e-commerce. At the same time, there are also fears of how the downturn in the economy or even tariffs could potentially impact retailers. But I think that these specific retail properties that are grocery anchored, service oriented, are much more resilient to e-commerce and even to the broader economy than the market gives them credit for. And so I really like the valuations relative to the fundamental strength of these REITs. But there are other property sectors. I like residential REITs, apartment REITs to be specific. They've suffered in recent years because of oversupply, especially in rapidly growing Sunbelt markets where it's easy to build, where land is abundant, in Texas as an example. But I think that conditions are likely to improve materially already in the near term in 2027, 2028, because the new supply is gradually declining now and at a rapid pace. And so I expect the market to now regain balance this year and rent growth to reaccelerate in 2027. And I think that the current valuations don't indicate that in the market. So this could potentially be an opportunity. There are others. I like cell tower REITs. Cell towers have also suffered in recent years because of tenant consolidation, which has led to stagnating cash flow growth. But the long-term prospects remain very compelling. I think that the consumption of data is going to keep growing at a rapid pace, perhaps even accelerate because of the AI revolution. And so I think that this could be, an underappreciated winner of the AI revolution over the long run.
And last year, NAREIT celebrated 65 years of REITs. As you look ahead, what further evolution and diversification do you think might occur?
So I think that the same trends will continue. I think we'll see a lot more new REITs emerge, focusing on even nichier property sectors than we have today. Already today we have some very niche ones like cannabis cultivation facilities. We have casinos, we have cold storage. A lot of things. And I think that this trend will continue. We'll see even more new REIT IPOs focusing on these specialty property sectors, giving investors even more opportunities to diversify. At the same time, I think that we'll see more and more American REITs also start to expand abroad. Recently, we saw Vici Properties buy some casinos in Canada. I think we'll see more and more similar moves going forward as the existing REITs grow in size and start moving abroad in markets that perhaps are a bit less competitive. REITs in the past few years have done quite poorly, and the sentiment has been quite negative because of the surge in interest rates, the oversupply in some key markets. But overall, I'm very optimistic about the long-term prospects of REITs. And it's simply because I'm strongly convinced that in most cases, REITs offer better returns with lower risk and less required effort, as I mentioned earlier, than private real estate. And I think that as more investors come to the same realization, hopefully in part thanks to my book, more capital will flow from private real estate into the REIT market. And this will lead to more demand for the shares of REITs, which will push their valuations higher, allow them to raise more equity, grow faster, so the existing REITs will grow in size. And at the same time, new REIT IPOs will also occur. But this will, of course, take time. But I think that as we spread this message about the REIT sector, I think that their sentiment can only improve. And, today, again, there's still a lot of misunderstandings about the sector, but we'll keep working hard to address those.
And finally, any parting thoughts for potential investors wanting to invest in REITs today?
Well, the message I've been trying to bring home here that I've already repeated quite a few times, that I think that REITs are simply a better way to invest in private real estate in most cases. There are quite a few studies that show that they earn higher returns in most cases. Those studies show that they generate 2 to 4% higher annual returns on average than private equity real estate. And there are good reasons for this. They enjoy significant economies of scale. They have access to the best talent. Thanks to their scale, they have better bargaining power with their tenants. They can often build their own properties to earn higher returns. They can earn additional profits by offering services to other investors, and you participate in those additional profits as a shareholder. Many other reasons. But they're also safer because they are public, they are liquid, they are widely diversified, they are professionally managed, they are conservatively financed in most cases. Investors also don't have any liability risk here, unlike in the case of private real estate. And, you have a management team handle everything for you in a very cost-efficient way because REITs have this scale advantage. And so it's totally passive as well. So if you want to invest in real estate, as you probably should, it's one of the biggest asset classes in the world. I think it deserves a place in a broad asset allocation of most investors. Then I think you should be considering REITs. And a final point here that I think could quite be interesting for new investors looking at REITs is that their valuations today are historically low, because they've just suffered in recent years from poor market sentiment, from the surge in interest rates, some overbuilding. And as a result, a lot of REITs today trade at steep discount relative to their net asset values. And so what it means is that you essentially get to buy real estate at a discount in the REIT market and then get the added benefits of what I mentioned earlier: liquidity, diversification, professional management, and so on. And so, if you're looking to invest in real estate, I think you should be considering REITs.
Excellent. Jussi, thank you so much.
Thank you for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.